Good day and welcome to the Q2 and FY26 earnings conference call of Anthem Biosciences Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rushabh Shah from Adfactors PR Investor Relations. Thank you and over to you, sir.
Thank you, Anushka. Good afternoon, everyone. I am Rushabh Shah from Adfactors Investor Relations. On behalf of Anthem Biosciences Limited, I would like to welcome you all to the earnings conference call for the Q2 and H1 FY26. Today on this call, we have with us from the management Mr. Ajay Bhardwaj, Managing Director and Chief Executive Officer, and Mr. Kavir Beg, Chief Financial Officer. We will begin the call with a brief opening remarks from the management, followed by a Q&A session. Please note that certain statements made during the call may be forward-looking in nature. Such forward-looking statements are subject to certain risks and uncertainties that could cause the actual results or projections to differ materially from those statements. Anthem Biosciences Limited will not be in any way responsible for any actions taken based on such statements and undertakes no obligations to publicly update these forward-looking statements. I would like to now hand over the call to Mr. Ajay Bhardwaj for his opening remarks. Thank you and over to you, sir.
Good morning, everybody. This is Ajay. We are here to present our H1 FY26 key financial highlights, and I'm very happy to report that we've had a good consolidated revenue growth from our operations to 1,090 crores for the half year up to 30th September. Our CRDMO business out of that has delivered 926 crores of revenue, and our specialty ingredients has delivered 163 crores in revenue. Our EBITDA has also grown and stands at 480 crores with EBITDA margin of 41.4%. And that is respectable growth. The other income in this in the first half is 71 crores, and the PAT, that is profit after tax for our business, stands at 309 crores with a PAT margin which has grown now to 26.6%. Our net cash position at the end of September 30th has improved to 993 crores of cash in hand. And this is in a snapshot the financial highlights of this first half for Anthem Biosciences. We are very enthused by the growth in our numbers, and we are quite confident that going forward we'll be able to deliver on what we think would be a good growth for the rest of the year. So I now open up the floor for question and answers. If there are any specific questions, our moderators will answer them openly and frankly. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Bansi Desai from JP Morgan. Please proceed.
Yeah, hi. Thanks for taking my question. So firstly, this quarter we saw our specialty ingredients business, reporting a decline. So if you could help us understand what was the reason, and how should we think about the specialty business growth for the rest of the year? And my second question is on our costs. So, we saw both employee expenses and other expenses decline year over year. I'm assuming some part of it would be because of ESOP costs being in the base, but if you could help us understand, is this the sustainable base from here on?
Yeah, Bansi. The specialty ingredients business, and we have said this throughout whenever we presented our company, is that our capacities, the way we have created the capacities is that they're fungible between our CRDMO and our specialty ingredients business. So we actually have had, since the CRDMO part has been busy, we are therefore at that time we do take a little step back from our specialty ingredients capacity availability, and therefore our our specialty ingredients business will from time to time show a little slowdown. Overall, it's a business that is a healthy business. It does help us, when we do new expansions and we are waiting for large customers or large programs to come and fill up those capacities. Our specialty ingredients business helps us generating revenue and turning around our manufacturing capacities or our manufacturing facilities very early on. And that will continue to be the case. And overall, if you see our specialty ingredients business, even though it's in some years it is flat, it has consistently grown. It's trending upwards. We expect that also to continue. But at the same time, if we have over demand for our facilities for our CDMO business or CMO business in that case, we would actually tend to divert resources to that. And that's always good news for us. So we do see a decline this year in this half in specialty ingredients, but I think this will hold up in the rest of the year. But there's nothing to worry about. The business is solid and it continues to grow.
Just to add on that, Bansi, so in quarter one, we added our CP6, we commissioned it and we inaugurated the CP6 block. Just about a week back, we also inaugurated our CP7 block. So our Unit 2 expansion, which is roughly about 130 kiloliters of expansion, is now complete. So now we have adequate capacity which could be able to cater to both our segments. And hence, we feel that going forward, for at least for this year, we feel specialty ingredients will be able to make up for the decline which we had seen in H1. With respect to the second part of the question on the employee cost, yes, you are absolutely right. In H1 of last year, we had employee cost which was roughly about 16 or 17% of sales, and that included about 36 crores of ESOP charge that we had taken into consideration because that was the first year of the ESOP allotment. For this half, we have taken the charge. ESOP charge is roughly about 8 crores, 4 crores each broadly for quarter one and quarter two. Net of that, if you look at it, the employee cost has largely been around that 12.5 odd percentage as a percentage of sales for both H1 of last year as well as H1 of this year. We feel that that's a decent enough employee cost percentage which will continue to be in. Other expenses have broadly been in the same zip code when it comes to H1 and H1 of this year as well as last year, and that's something also what we have been striving to deliver in terms of how do we create more operating leverage in the business, and which is reflecting in the operating expense reduction and the overall margin improvement that we are seeing in the business right now.
All right, just one clarification. So this ESOP cost, 4 crore per quarter, is this likely to also come down starting next year?
Yes, for the options that we have granted, which is roughly about 90% of the pool, it's on a sliding scale. So 36 crores we recognized last year. This year is about 16 crores, which is what we have split across the first two quarters of 4 and 4. Going forward, it's going to come down further.
All right, I have more questions. I'll join back.
Thanks.
Yeah, thanks.
Thank you. A reminder to the participants, In order to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Nikhil Mathur from HDFC Mutual Fund. Please proceed.
Yeah, hi. Good afternoon. My first question is on the capacities. So with the new block coming on stream in Unit 2, and we have commissioned in 1Q as well, can you talk about the revenue potential from these two capacity additions? And also, if you can help us with Unit 3 utilization. I mean, I suspect it might not be fully utilized yet. So how the Unit 3 is kind of shaping up?
Okay, I can take the Unit 3 part, and Gawir will answer the thing that, you have to take it into proportion of how much capacity we've added in Unit 2 versus what was there earlier. Unit 3, as we said, has a lot of specialty blocks. We have commissioned it now, and compared to the previous years, we have a very good WIP, so work in progress in Unit 3, and many more POs are now coming into Unit 3, and I wouldn't put a number to it, but it will be a substantially larger number than it has been in the previous years. So by the end of the year, and that's what we are going to be tracking for, by the end of the year, Unit 3, which is Neo Anthem, will also deliver a decent number. It still won't be, in profitable zone, but it is trending upwards significantly now.
Okay. On Unit 2, roughly, I think CP6 and CP7, 130 kiloliters have been commissioned right now. All put together, close to about 182 odd crores of capex have gone in CP6 and CP7. It's completely unutilized at this point of time with lower capacity utilization. So we have, based on our asset turnover, which is roughly about 1.6x, 1.7x, we feel the revenue potential will be similar from here, close to about 300 plus crores is what we can look at generating from CP6, CP7. On Neo Anthem, as it stands for 30th September, our gross block plus CWIP is about 350 crores. Plus there is a couple of additional blocks on fermentation which is yet to be commissioned. So all put together, our gross block will be close to about 450 crores plus over there. And this includes the high-end manufacturing of peptides and high-potent compounds, plus fermentation and biotransformation is also what we're adding. So we expect that once, on a full stream basis, if it comes up, the long-term target on this is also to deliver about 1.4 to 1.5x on asset turnover. So on 450 crores capital base, we can generate close to about 650 crores of revenues on a long-term basis. I'm not talking about near-term, but it will take some time in terms of peptides and high-potent and other fermentation block to be filled up completely.
Right. So, I mean, what we are hearing from the industry, I mean, from your peers and your commentary as well in the last 6-9 months, that there is a inflow of RFPs to Indian companies. There is a better order backlog for the companies. So, basis this 450 crores of gross block that is to be absorbed by Anthem over the next 2-3 years, you are not at loss of capacity for any increased RFP that are coming your way, right?
Yeah, Nikhil, that's why we have, in our business, we have to build it and then they will come. And we are ready with capacities to service new RFPs. And you're right, we've had surprisingly some good, good new inquiries, which we are very enthused by.
Understood. Secondly, from a longer-term perspective, let's say 4-5 years, the Unit 4, which the land parcel is there in the books for you, how do you think that will shape up in terms of that facility getting commissioned? And when are you likely to pursue orders for that particular facility? I mean, when is the first revenue that one should expect from that unit?
Okay, we've started the work already on Unit 4. We've informed all of you about that. I think the civil works are in very good shape, and when you visit next time, we'll show it to you as well. And this unit should be, as we have said, consistently commissioned in 2 years from now. It's a greenfield project, and it's a significant, investment we are making there to the tune of 1,000 crores. So we are absolutely positioning the company to become a leading player in this whole space. We already are, but to become, significantly important in terms of both capacity and availability of skills. So we are definitely on track to get this done in 2 years' time.
Understood. If I may ask 2 more questions, can I go ahead?
Hanji, puche.
Okay. On the employee headcount front, before the Unit 4 kind of kicks in, how many employees do you need to add in terms of manufacturing, R&D? I mean, is your current headcount good enough to take in the orders that you are envisaging next 2 years?
So, go ahead.
See, with respect to Unit 4, we need to add people.
Unit 3 also will need, as we expand, as we fill up the thing, there will be a need for more people. But we are very mindful in terms of hiring, and we are careful hirers. So we do take into account how we can, optimize headcount. So we will need to hire, if we are going to increase our revenues from Unit 3, we will need more people. But the way we go about is we transfer some trained people from Unit 2 and Unit 1 to these new units, and under those people who have already fully absorbed our systems of our way of operating, we train new people. So usually there is a very good hand-holding and a very good training program which allows us to get industry-ready people by investing heavily in people training. So we are going to do that, and we are already doing that in Unit 3, and that will continue to happen.
So if the employee addition will be in a calibrated manner and you will have a revenue growth next 2-3 years, would the current level of margins be sustainable then?
Yes, Nikhil. We've been very mindful in terms of having the ratio of employee cost as a percentage of sales is something what we track. And in the industry, we would be amongst the lowest from an employee cost as a percentage of sales, and we'll be mindful about that in terms of how we are looking at adding resources. The revenue growth, which you will see in new Anthem, or subsequently also when Unit 4 gets commissioned, and the base what we need to add from an employee point of view will reflect the employee cost as a percentage of sales in similar lines. So there won't be any, we don't anticipate that we'll be looking at a margin compression. Rather, we'll continue to hold our margins as we have done in the past.
Yeah, I mean, you can see that EBITDA growth has been healthy even now, and we believe that this will continue to be.
Got it, sir. This is very helpful. Thank you so much.
Thanks, Nikhil.
Thank you. Before we proceed with the next question, a reminder to the participants, in order to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Payal Mukherjee from Nomura. Please proceed.
Yeah, hi sir, good afternoon. So my first question, if you can give some color on the, the pipeline in terms of, phase 3 assets, and how should we think about commercial quantities, for those assets, and also in your existing commercial products, are you seeing any significant volatility in your products, or we should expect a steady sort of 20% kind of growth that, you have guided for earlier?
Yeah, hi, Sayan. First up, the first part of your question. You see, when we actually, in July, when we IPO'd the company, we had 10 commercial molecules in our fold, and this is what we had put in our DRHP. the next quarter, if you will look at it, the last quarter, the quarter Q1, it had increased to 12 commercial products. So 2 more products were added to, which were approved, where we support our customers. In the last quarter, another 2 have been added. So today, we are actually addressing 14 commercial molecules, where Anthem is developed and is now going to participate or is participating in the supply of advanced intermediates or APIs. Now, in terms of their future of these products, analysts have said that some of these could be blockbusters, and we are very enthused by that. But, when you launch the product and for it to go to blockbuster status, it takes some time as well. But we are there with our customer to support them. And we are also very, you can see from 10, now it's 14 molecules that are commercial. That's a 40% growth in approved molecules. And if you remember, at the time of listing, we had said that we had about
10 late-phase molecules.
Yeah, we had 10 late-phase molecules. So that pipeline continues to be healthy. And, our funnel, as we have talked about in the past, we've added more customers in the early stage. There are good ones which are moved to now the middle stages. And we have 4 new approved molecules. And so again, some of the late stage are moving into the phase 3 part. So we see this as a very important part of our sustainable growth, and that's what Anthem is aiming for. And yeah, we are very, very, very. That's why we have created these new capacities. We're not doing this, for any other reason. Now our new units, and these are in Unit 2, which is already an FDA-approved unit. These capacity expansions are there so that we are able to support increased volume from our customers. As far as our current molecules go, there is a decent amount of orders in hand, and we expect that these molecules will continue to grow for our customers. So, but again, the word of caution in all this is it depends on how our customers perform, and we have very good customers, and so far they are doing well. So we are confident that we will deliver the growth that we have been talking about, both in terms of earnings and revenue top line.
Right. So just to clarify, now you would have 6 late-stage assets, right? Because since the IPO time,
the 10 late-phase has gone down to 6 because 4 of them have moved to commercial now. So from 10 commercial plus 10 late-phase, it's now 14 commercial and 6 late-phase.
Understood. Actually, a lot of these late-stage pipelines have got commercial, in quick succession. So the remaining 6 that we have, do you have any visibility? When should we expect, assuming everything goes right, when should we expect those 6 to enter the commercial phase?
Yeah, मेरा बस चले तो मैं बोलूँ कल हो जाए, but it is not in our hands. So the thing in this is a process which is entirely controlled by FDA and our customer. And but you can imagine, most of these companies are, they are biotech companies. They also have a cash burn going on, so they are very keen to push these through and have them approved as soon as possible. So do I have a visibility on when they'll be approved? No. Like if you had asked me at the time of listing, will we have 4 new products by end of Q2 or in the first half, I wouldn't have been able to predict. It's the same going forward. But the good news is that we have a very good funnel, and there also now we have, and without naming customers, which I can't, we have some inquiries for new RFPs, which are existing molecules for our customers, and we expect, some good sales to come from commercialized molecules where we are now going to support our customers, maybe as a second source, and that is also going to be, as you people had asked us, all of you, that are you targeting those type of customers? And we had told you yes, and we are seeing some fructification of that also going on.
Okay, that's great. And so last question, if I can ask on margins, you had talked about 35-40% margin level. Now with the new facilities coming on stream, and at the same time, I think there could be some benefit because of currency. any fresh thoughts on guidance? Should we think about being at the upper end, or how should we think about EBITDA margins, in the coming quarters and next year?
So, Stan, if you look at the margins for this half year, we have done about 41.4% margins, out of which about close to 2 to 3% of our margins is attributable to FX income, because Forex net is roughly about 34 odd crores that we have recognized for this half year. Largely it has been an impact on it has been an increase on account of employee cost reduction, other expenses reduction. There is a bit of a split on product level margins, etc. So I think on an overall basis going forward, we'll be on the upper end of the 36-37% that we have always guided towards on the EBITDA margins level, and largely because of the cost element, which we are quite conscious of in terms of how do we keep it in a check situation so that our various cost element as a percentage of sales shouldn't increase significantly from what we have been delivering so far. So upper end of the segment is what of the 36-37 of what we have been guiding is what we'll be looking at achieving for the full year also.
Okay. Thank you. I'll join back. Thanks.
Thank you. We take the next question from the line of Gaurav Bhama from GM Financial. Please proceed.
Hi, sir. Good afternoon. Firstly, congratulations on great set of numbers. I just had two small hygiene check questions. In the presentation, there are two particular numbers that I wanted to inquire about. The first is 56.4% commercial molecules contribution to revenue, and the second is 9.8% R&D services contribution to revenue. Is it on a quarter basis or a half-yearly basis, sir?
This is half year.
Half-year. Thank you, sir. That's it from my end.
Thank you. We take the next question from the line of Damayanti Kerai from HSBC. Please proceed.
Hi, thank you for the opportunity. My question is regarding two opportunity segments which you indicated could be interesting. So if you can share any update on how biosimilars and generic GLP semaglutide opportunities are shaping up for you. Do you have any visibility of these segments contributing meaningfully towards the revenue in near term?
Yeah, so we are progressing steadily in that area. We are, as you can imagine, we have to produce PV batches and all the rest of it, which is what is going on. And then we have to get the plant approved by FDA. But that will, in the near term, you and I may define near term differently, but it won't happen in the next 2 quarters, but we will see after that, I think, some positive traction in these areas where we are doing and then the GLP in the biosimilar. Then GLP-1, yes, that's an opportunity which we are working with quite strongly. And we are working with a bunch of innovators as well in this whole area. So the point I'm trying to make is that, this is going to be a very active field, and I think Anthem will arguably have one of the strongest positions in this space, because we are fully integrated all the way backward. Because most of the people who are doing these products, particularly the first one that's going off patent, semaglutide, most companies are looking to get the fermentation fragment from outside, primarily China. Anthem is not going to do that. Anthem will work, has